Good morning. I'm Vince Lancy, and this is the Gold Fix Morning Market Rundown. Gold, 3,300 and the beginning of panic. Starting with the markets, 10-year yields are 432, down 1.5. The dollar is 99.63, down 46. The S&P 500 is 53.52, down 39. The VIX is 31.62, up 1.5. Gold is $3,307, up 78, 79, $80 as we speak. Silver is 32.97, up 67 cents. Copper is 453, down 4 cents. WTI is 61.80, up 28 cents. Natural gas is 326, down almost 6 cents. Bitcoin is 84,000 and change, up 424. Palladium is 979, up 7. Platinum is 965, up almost 6. Gold, silver is focused on the 100 area right now. Grains, soybeans are 1033, up 2.5. Corn is 480, up almost 3 cents, and wheat is 558, up almost 5 cents. Gold is trading $3,300. And as of this morning, today, right now, very sensible, very serious people are beginning to panic. These people, executives at banks, leaders worldwide, with an epicenter in Europe, these people are pointing towards extraordinary outcomes now, specifically the diminishment of the dollar's reserve status. And as a function thereof, a complete rebalancing by global banks from its current 58% held as a weighting of reserves to as low as 40%, weighting which would necessitate an almost tripling of gold reserves held by them. Currently, central bank average reserves of gold are about 10% of their makeup, and that's after buying it for several years. 30% might be the optimized percentage. Gold surged through $3,300 an ounce this morning and into record territory, marks a break from the speculative spikes of the past, unlike the 1980 rally, which is now being talked about as a comparable situation. That faded with geopolitical resolution. This move is rooted in a broader structural shift. The core difference is global trust has eroded without a functioning mechanism for recovery of it. Trade war escalation, waning confidence in U.S. security guarantees, sanctions, weaponization of the dollar, and a retreat from coordinated global responses are embedding gold as a strategic reserve asset across both state and institutional portfolios. Back then, referring to 1980, the world was beginning to globalize and tear walls down. The world currently, however, is in the process of raising walls and deglobalizing along mercantile protectionist lines. Gold is not spiking on crisis right now. It is repricing on fracture. Gold's ascent, as of this morning, up 25% year to date after a 27% rally in 2024, has naturally drawn these comparisons to the 1980 peak, triggered by the Iranian Revolution and the oil shock. That previous crisis was followed by swift coordination. Today, there is no expectation of resolution. In fact, the market is pricing in its opposite, deeper division. The breakdown in international cooperation in the last few years has led to gold staying permanently high. This is a bigger geopolitical bid in the market than a crisis itself. The gold price is now reflecting the end of global trust, not just another cycle. That shift has created a different kind of market, less reactive, more anticipatory. Traders are not just hedging risk, sovereigns are insulating against systemic reordering. Gold, unchained from US dollar correlations, which only served to placate neo-Keynesian economists that all was happening as it was supposed to, has retaken its role as a leading indicator, not seen since the 80s. Gold's most recent leg higher, possibly culminating today, has coincided with President Trump's announcement of the most aggressive U.S. tariff package in over a century. Emphasis on the word coincided. While the metal is inversely correlated with global trade volumes, it's not tariffs that are moving price. Rather, it's the recognition that trade fragmentation is part of a longer, larger arc of deglobalization, a structural transformation with no reversal in sight. Unlike recent crises that triggered coordinated global responses, this time there's no real prospect of policy alignment that we can see. That lack of geopolitical alignment is a risk premium in and of itself. Markets no longer assume there is a global backstop. Each country, each central bank, and each investor must now hedge not just volatility, but fragmentation. Just as supply chains are shifting from longer and offshore to shorter and onshore, so have payment chains begun to shift towards onshoring. Not only do they want the gold, they need it close at hand. The world's central bankers are now stackers. The turning point will be pointed towards tariffs. Tariffs are not the reason for this. The turning point was not tariffs, at least not alone. Tariffs are the accelerant. The turning point was the precedent set by freezing Russia's reserves in 2022. That single act realigned how non-Western central banks view the dollar. Gold, unencumbered by jurisdiction or intermediary risk, became the default reserve diversification asset. From that moment on, the marginal global buyer of gold shifted from ETF speculators to central banks. The Russo-Ukraine war asset freeze did not create a flight to gold. It created a flight into gold by institutions that now fear the dollar and its swift plumbing may be selectively inaccessible. As was done to Russia by Biden, may be done to any nation by Trump or his successor. This dynamic continues to anchor flows into gold. The buy side is no longer exclusively Western or ETF driven. It is now balance sheet driven by public sector sovereign actors with multi-generational time horizons. About that 1980 high. While gold has hit new nominal highs, inflation-adjusted levels still lag the 1980 peak. 850 then equals about $3,486 now. One more milestone remains, the peak in real terms of that 850 hit in 1980. By implication, the price signal is only part of the story. The composition of buying, the drivers of the bid, and the lack of coordinated fiscal monetary policy globally all suggest the top is not in. The risk to gold is no longer geopolitical. It's recoordination. If global stability miraculously returns, if trade wars vanish, if the Fed hikes and normalcy returns, or the Fed eases and normalcy returns, then yes, the trade may unwind, but that's unlikely. The market agrees. The price of gold is no longer something that can be forecast or has to be forecast. It's a function of changes. You can quantify why gold is going up in real numbers now. fractures are permanent. Earthquakes create fissures that take generations to rebuild, to fill in. Gold is not rising because of any single event. It is rising because the institutions that previously managed risk, global alliances, central bank policy coordination, and unimpeded capital flow are no longer reliable. Each event, tariffs, Ukraine, dollar weaponization, potential weaponization of SWIFT, is part of a larger realignment. This rally is not a hedge, it's a revaluation. These are the stories that Goldfix put out yesterday. A video describing Goldman eyeing 4,500. The founders got to see the actual plumbing in China that goes into buying or not buying gold, and how they are de-dollarizing. Effectively a quid pro quo graphic showing treasury sales followed by gold buys day after day. Connecticut was going to be the top story today, since it's my home state, has gone for the gold. They are lobbying for gold to be monetized in the state. Gold is not spiking on crisis. It is repricing on fracture. That post was sent out yesterday. Much of what I discussed today, what I said prior, was in that post. Another post for the founders: the U.S. needs a new nation to buy its treasuries, so it created one. That would be stablecoins. And another story: India to buy U.S. gold and silver to rebalance U.S. trade under Trump. Which, incidentally, stories like that, I think, are why sensible people are starting to panic. Now, panic is when sensible people panic, that's denial being lifted, the veil being lifted, the denial veil being lifted away from their faces. So the note that I saw this morning, courtesy of Zero Hedge, I appreciate that, inspired this conversation. You know, when sensible people, bank heads, global bank heads, start talking about repricing gold in terms of dollars, because central banks are going to be offloading more and more dollars, related to that very first slide I gave you at Bank of America. That's panic. Okay. And like Michael Hartnett said, again, Bank of America, markets stop panicking when leaders start panicking. And I bring that up because that's the risk today. I think if people are starting to, at the executive sovereign level, starting to openly panic about something they've been not paying attention to because they're worried about day-to-day gyrations in the market, then you could have a coordinated action that slows or stems this. It could be a Bank of Japan, Fed coordinated action, but it's not going to make people friendly again. It's not going to make people hope again. It's just buying time. Remember, they don't care about price. They care about speed of price. At least that's my contention. Still. Markets recap. Wall Street ended lower as trade uncertainty kept investors on edge despite upbeat bank earnings. Treasury yields dipped ahead of retail sales data and Powell's comments. The dollar gained, showing signs of recovery. Gold rose on safe haven demand. Oil prices were steady as market considered latest U.S. tariff changes. As the market, typo there. Canada's main stock index rose as domestic inflation rate unexpectedly cooled, while prospects of automotive tariff exemptions further lifted investor sentiment. Remember, good cop, bad cop. That's all Trump does when he's doing his horse trading games. Toronto Stock Exchange S&P TSX Composite Index rose 84 basis points higher to 24,067. Full analysis continues at the bottom. Market news. There are a lot of diverging news stories, but I'm focusing on good stories today. Good news for the economy. China orders airlines to suspend Boeing jet deliveries amid trade war. Bloomberg News reports. Why is that a good story? Because China doesn't buy jets from Boeing anyway. That's like us, again, suspending pistachio deliveries from Iran. They don't, it's not, what's the word? It's not performative. It's, uh, it's theatrical. Apple airlifted iPhones worth a record $2 billion from India in March as Trump tariffs loomed. Apple's main India suppliers are listed as well. AMD, this is more good news. AMD is set to produce its CPU chip at TSMC plant in Arizona. That is the plant, that is the onshoring of supply chains. One of the things that we need to do, discussed in this space for years, is we need to onshore supply chain, specifically in areas that we can excel at and areas that we can harness to make us lower cost producers. These stories and more are in premium. And of course, OpenAI, ChatGPT, is working on an X-like social media network, The Verge reports, which is, frankly, obvious. It should have been obvious. It has been obvious. But the reality of it is the AI product that X uses and ChatGPT uses, it's in the process of being commoditized already. And when the product is no longer new, the network matters. The message becomes the distribution center. For example, Big Mac, Whopper, who cares? Uber is the plumbing that gets it to you. So that's the concept there. Sam Altman, genius that he is so focused on the product that he can't stand a little competition. And so he needs real data. Elon Musk has real data, right? He needs distribution. Users on X, like myself, we're the marketers of his product. We're the ones that get it out there. We're millions of little tiny journalists. And that's going to increase use, increase data, and a virtual, self-reinforcing, virtuous cycle is now engaged. ChatGPT's product could be better in some areas than Grok. They've recently upgraded their pictures. I used some of their pictures for the presentation that we just did, and they finally have gotten good. They've learned how to spell wonder of wonders. Anyway, that's the market news, right? So data just came out while I'm doing this. Retail sales were expected, I think, at 1.4%. That's Market Watch. They're wrong. It was revised to 1.4, and I think it came out at 1.4. So the retail sales comes in, and what do the markets do? Well, let's look at the markets now, right? Gold remains firm. Let's go to an hourly version, right? So gold doesn't care. 10-year yields don't seem to care much. The dollar slightly firmer. That's probably some shorts covering on the number. Silver, an economic metal, a little bit of a bounce. WTI, a little bit more of a bounce. Natural gas, these are hourly charts. Lower, again, marching to its own tune. Bitcoin nowhere. PGMs still firm, but nothing crazy. In summary, the beginning of panic is now seen at the sovereign and institutional global banking level. 3,300 is the result of that panic. This price spike is not because of a crisis. It's because of a lack of response to a slow-moving crisis that is the end of dollar dominance in the world.